What if everything you thought you knew about crypto was built on the wrong question? Most people are asking which coin is going to pump next, but the people quietly moving trillions of dollars are asking something completely different. They're asking which network is going to become the backbone of the global financial system. And that single shift in framing changes everything. Because if they're right, then the next decade isn't about trading. It's about infrastructure. And infrastructure doesn't care about your entry price. It doesn't care about your sentiment. It doesn't care about the chart. Infrastructure just needs to work. And the institutions that are quietly building right now understand that better than almost anyone talking about crypto on the internet today. Raoul Pal, one of the most respected macro analysts in the world, has put forward a prediction that the total crypto market could reach $100 trillion by 2032 to 2034. Now, before you assume this is just another number thrown around to get clicks, let's actually look at the reasoning behind it, because the model he's using isn't based on hype. It's not based on vibes. It's not based on what someone posted on Twitter at 2 in the morning. It's based on how networks grow over time. Metcalfe's law, which has been used to model the growth of Google, Facebook, and the NASDAQ itself, suggests that the value of a network grows exponentially as more participants join it. The more nodes, the more connections. The more connections, the more value. When you apply a logarithmic regression channel to Bitcoin's market cap over its entire history, you get a curve. And that curve, if it holds, points toward that 100 trillion figure within the next decade. That's not a guarantee. That's a model. And models can be wrong. They can break. External shocks can invalidate them entirely. But the underlying logic is not irrational. And that distinction matters enormously when you're trying to think clearly about where this space is actually going versus where people want it to go. The reason most people miss what Raoul Pal is actually saying is because they hear a big number and they immediately translate it into a personal profit fantasy. That's not the exercise. The exercise is understanding adoption curves. Every major technology network in modern history followed a similar path. Slow, almost invisible growth at the beginning, then a period where adoption appears to accelerate, then a tipping point where the technology becomes embedded in daily life and people stop thinking of it as a technology and just start thinking of it as the way things work. That's the crypto endgame that serious analysts are describing, not a world where everyone is checking price charts, a world where people are using distributed ledger infrastructure without even knowing it, where stablecoins move through apps like X and Meta the same way a text message moves today, where settlement happens in seconds and nobody thinks it's remarkable because it just works. That is the $100 trillion scenario, and it has nothing to do with which influencer is shilling which altcoin this week. Now here's where it gets interesting, and where most retail conversations miss the point entirely. RippleX, the development arm behind the XRP Ledger, recently laid out their goals for 2026 in an interview with The Block. And what Marcus and Fanger, the senior vice president, described wasn't a trading pitch. It wasn't price prediction content. It was an infrastructure roadmap. They're focused on bringing high-quality real-world assets onto the XRP Ledger, building out institutional lending protocols, smart escrows, atomic swaps, and what they're calling collateral mobility. If you strip away the crypto branding and read those words again slowly, you'll recognize them. Real-world assets, lending protocols, collateral mobility, atomic settlement. That is the language of institutional finance. That is how banks talk. That is how asset managers talk. That is how clearinghouses and settlement systems describe their core operations. The question worth sitting with is not whether XRP goes up next month. The question is whether these tools, if they're built and adopted as described, could become part of how financial institutions actually move money, manage collateral, and settle obligations at scale. What RippleX is describing when they talk about institutional DeFi is essentially an attempt to take the most useful primitives that decentralized finance developed in the last few years and make them compliant, permissioned, and reliable enough for institutions to use without regulatory exposure. Lending protocols on a public ledger. Smart escrows that execute automatically when conditions are met. Atomic swaps that eliminate counterparty risk by making the exchange of assets simultaneous and irreversible. These are not new ideas in finance. They are very old ideas. The innovation is doing them on programmable infrastructure that doesn't require a phone call to a relationship manager and 3 days of settlement time. When you understand it that way, the conversation shifts. It's not about crypto versus traditional finance anymore. It's about which version of financial infrastructure wins the next 30 years. Ripple's stated long-term goal has never been to replace Bitcoin or win a retail trading contest. From its earliest days, the company's pitch to the market was simple. Banks have legacy systems that are slow, expensive, and fragile. We can replace them. The original use case was cross-border payments, the kind that take 3 to 5 business days and cost fees that disproportionately hurt the people who can least afford them. Ripple built technology that could do the same thing in seconds for fractions of a cent. That was the vision. And over the years, the infrastructure layer they've been building has gotten significantly more complex and more ambitious. They've added custody services. They've built wallets as a service. They are actively pursuing an OCC bank charter, which would give them the regulatory standing of a nationally chartered bank in the United States. And if they achieve a direct operational connection to systems like FedNow or FedWire, the Federal Reserve's real-time payment and wire transfer networks, the position they would occupy inside the U.S. financial system would be fundamentally different from anything a crypto company has held before. Not because of speculation, not because of market cap, but because infrastructure embedded inside existing financial plumbing is extraordinarily difficult to remove once it's there. That is not a crypto argument. That is just how legacy systems work. Swift has been criticized for decades. It's still here. Visa and MasterCard were supposed to be disrupted. They're still here. Ripple is making a calculated bet that they can become the new default before the old default figures out how to modernize itself. XRP itself has been positioned since its earliest days as a bridge asset, not a store of value in the way Bitcoin frames itself, not a smart contract platform in the way Ethereum does. A bridge. A way to move value between currencies, between institutions, between ledgers, without requiring either party to hold the other's currency, without requiring a pre-funded Nostro account sitting idle in every market you want to operate in. For correspondent banking, that pre-funding problem is a multi-trillion-dollar inefficiency. Money that could be deployed productively is instead sitting in accounts around the world just to enable transactions. If XRP or any neutral bridge asset can reduce that burden, the financial case is real regardless of what the price is doing on any given day. In a world where financial markets are increasingly tokenizing everything from treasury bonds to real estate to private equity, the need for a neutral settlement and liquidity layer becomes structurally more relevant over time, not less. Whether XRP fills that role at scale is still genuinely an open question. The technology may support it. The regulatory clarity may eventually arrive, but execution, adoption, competition from other networks, and the very real possibility that banks build their own closed versions of this infrastructure are all factors that matter, and that no honest analyst can simply wave away. Raoul Pal's macro argument isn't just about XRP or any single asset. It's about a generational shift in how capital flows through the global economy. Sovereign wealth funds in the Middle East, entities managing hundreds of billions of dollars on behalf of entire nations, are actively investing in blockchain infrastructure, not just as a speculative bet on Bitcoin as a reserve asset, but as part of building out government financial rails, public sector payment systems, and entire economic zones on distributed ledger technology. Abu Dhabi, Saudi Arabia, Qatar. These are not places experimenting with crypto because they saw something on social media. These are state actors with long planning horizons making strategic infrastructure bets. At the same time, major consumer platforms are integrating stablecoins. Meta has revisited digital payments infrastructure. X, under its current ownership, has been explicit about building out financial services. The on-ramps are being constructed from multiple directions simultaneously. Institutional custody is becoming standardized. Prime brokerage for digital assets is emerging. Tokenized money market funds are live. The infrastructure for institutional capital to flow into this space at a scale that retail traders cannot fully conceptualize is being built right now, quietly, without much fanfare. because the people building it don't need retail excitement to do their jobs. That brings us to something most YouTube crypto content will not tell you directly, at least not plainly. The regulatory battle happening right now in Washington is not primarily about protecting retail investors. It is about who controls the infrastructure layer. The Clarity Act, which would define whether certain digital assets are treated as commodities or securities under U.S. law, has become a major political flashpoint. Banks are lobbying aggressively, not because they hate blockchain technology, but because they understand that whoever controls the regulatory definition of these assets controls who gets to build the rails, who gets to custody them, and who gets to earn the fees on every transaction that flows through the system. Brian Armstrong from Coinbase publicly pulled support from the Clarity Act, and he was candid about why. Parts of the bill would directly conflict with Coinbase's existing infrastructure and business model. This isn't corruption. This is how every major industry in America operates when the rules of the road are being written. Everyone is fighting for the version of regulation that benefits them. The CFTC has signaled that even without new legislation, regulators could potentially create rules that open the door for institutional participation in crypto markets. But here's the catch. Rules created by regulatory agencies without an act of Congress can be reversed by the next administration. They are inherently temporary. Legislation is durable. And that gap between durable and temporary is exactly where uncertainty lives. And uncertainty is a tax on every business trying to build long-term infrastructure in this space. And here's the part that almost never gets said clearly enough in this space. And it needs to be said because a lot of people are making financial decisions without fully understanding the environment they're operating in. If you are a retail trader participating in crypto markets, you are not competing against other retail traders who are also guessing. You are competing against trading desks with hundreds of millions in capital. You are competing against firms with proprietary data feeds that see order flow before you do. You are competing against algorithmic execution systems that can enter and exit positions in microseconds. You are competing against teams of analysts, risk managers, and quants whose entire professional existence is dedicated to finding the edge in exactly the market you're casually participating in. When prices move violently and liquidations cascade in sequence, wiping out leveraged positions up and down the book, that is not random volatility. It is the natural and predictable result of a market where depth is shallow, where funding rates create exploitable imbalances, and where the largest players have every structural advantage over smaller participants. This is not a reason to avoid the space entirely. It is a reason to be brutally honest with yourself about what you are actually doing and why. Speculation and infrastructure investment are two completely different activities. Long-term conviction in a thesis about financial infrastructure is one thing. Trading leverage on short-term price movements in a market dominated by professional desks is a very different thing. Conflating those two activities is where a lot of people quietly lose significant amounts of money while telling themselves a story about being early to something important. The macro environment adds another full layer of complexity that even serious analysts are openly struggling to navigate right now. Interest rates, inflation, oil prices, and geopolitical tension are all live variables with real consequences for risk assets. The widespread expectation in markets has been that the Federal Reserve would cut rates, that cheaper money would flow into risk assets, and that this would extend the current cycle. But that expectation is conditional. If inflation ticks back up, whether from rising oil prices driven by instability in the Middle East, or from domestic supply-side pressures, or from tariff-driven cost increases working through the economy, the Fed's ability and willingness to cut rates gets constrained. The parallel to 2017 is worth taking seriously. That was a year where expectations about monetary policy shifted mid-cycle, and the dynamics of capital flows changed in ways that many participants didn't fully anticipate until after the fact. Oil prices are not a side conversation. They are a direct input into inflation calculations, and inflation is the single variable that most directly controls whether the interest rate environment that risk assets are hoping for actually materializes. Geopolitical stability in oil-producing regions is therefore a macro input for crypto markets in a way that seems counterintuitive until you trace the chain of causality. Instability pushes oil prices up. Higher oil prices feed into inflation. Higher inflation reduces the probability of rate cuts. Fewer rate cuts means tighter financial conditions. Tighter financial conditions are historically unfavorable for speculative risk assets. The chain is long, but it's coherent. And dismissing macro as irrelevant to crypto is a position that history has repeatedly and expensively punished. There's one more thing worth addressing, and it's about the nature of cycles themselves. Every major crypto cycle has been accompanied by a dominant narrative. In 2017, it was ICOs and the idea that every industry would be tokenized immediately. In 2020 and 2021, it was DeFi summer, followed by NFTs, followed by the metaverse. Each narrative attracted capital, and each one eventually ran into the gap between what was promised and what was actually built and used. The current cycle's dominant narratives involve real-world assets, institutional adoption, and infrastructure. Those narratives are more grounded in observable reality than some of their predecessors. Tokenized treasuries actually exist. Institutional custody actually exists. Stablecoin payment volumes are measurably growing. But the distance between promising infrastructure and infrastructure that is actually running at the scale required to justify the valuations being placed on it is still significant. The honest position is that the thesis is directionally plausible, the execution is partially underway, and the timeline and ultimate scale remain genuinely uncertain. Anyone telling you differently is either lying or has access to information that doesn't exist yet. If the next decade is really about rebuilding financial infrastructure on-chain, the question may not just be which assets succeed. It may be which networks become the actual rails of the next financial system. Rails don't need to be exciting. They don't need trending hashtags. They need to be reliable, compliant, scalable, and embedded deeply enough that switching costs become prohibitive over time. That is how Swift survived for 50 years, despite being almost universally criticized by the people who use it. That is how Visa and MasterCard maintained structural dominance long after analysts predicted their disruption. The projects and companies in this space that understand they are competing to become infrastructure, not competing to become the most talked about asset in the next bull run, are playing a fundamentally different game with a fundamentally different time horizon. Whether they win is genuinely uncertain. The incumbents are not standing still. Regulators will shape the outcome in ways no one can fully predict, and the macro environment will determine the pace of capital flows in ways that have nothing to do with the quality of the technology. But understanding the game that's actually being played beneath the noise of price predictions and social media cycles is the only honest starting point for evaluating whether any of this actually matters in the long run.